Yo, what is going on, guys? Welcome back to the Murdoch DeFi YouTube channel. And in today's video, we're going to be taking a look at a new project that's kind of come across my radar called BurnSwap. And essentially what this is kind of like the Swiss Army knife kind of DeFi, right? So obviously they have like a swap functionality or DEX functionality to what they're doing. They have a bridge. They also have some pretty interesting things going on in terms of staking. And as you can guess by the name of the protocol, BurnSwap, burning tokens is something that they're doing quite frequently. So I wanted to take this opportunity to kind of go through their white paper, kind of what problems they're solving in the DeFi space. They're getting ready to do, I think they're getting ready to do like their seed round stuff on April 10th. So there's still some time to get in here. Check out if it's something that you want to look furthermore into. That being said, guys, really everything in crypto and DeFi is inherently risky. I think we all know that by now. But that being said, let's go ahead and jump into their documentation and kind of go through what it is they have to offer. So what problems does BurnSwap solve? So new tokens and communities are always seeking ways to increase utility through deflationary exchange ways to increase utility through a deflationary exchange. There we go. And that's where BurnSwap comes in. As a decentralized exchange platform, BurnSwap allows for a seamless swapping between different cryptocurrencies while offering high yield staking opportunities, giving these tokens and their communities more scarcity to increase their overall value. Now, when I first read that, there's another protocol. I think it was called Only Burns or something like that. I don't know. I don't have like an update on where they're at. But that was one we had an AMA with, or one project that we had an AMA with. And initially when I came across BurnSwap, I just thought that it was kind of maybe a fork of that. But like reading through the stuff that we're going to be talking about today, that's clearly not the case. So BurnSwap's purpose is to provide deflationary utility to any crypto through its innovative burning mechanism via its bridge and swap function. It offers charts, tools, and project stats that make it a go-to dashboard for DeFi investors looking to earn lucrative yields while reducing the overall token supply. With BurnSwap, new tokens and their communities can find a powerful and secure platform to stake, swap, and burn their assets. Obviously, when we talk about different cryptocurrencies or different coins in general, DeFi or otherwise, it's obviously a very good thing if a protocol has a built-in functionality that helps burn their token, decreasing the overall total supply of that specific coin and potentially having a positive impact to the upside on the price action of the actual coin, right? So they also have their native token, since this is a DEX, and they're going to be bridging and things like that. They need to have their own native token. So the Burns token, which is the native to BurnSwap, like I said, serves a vital purpose in linking EVM compatible networks. EVM compatible networks are going to be things like Ethereum, BNB, AVAX, things like that. Things that are like ERC20 type tokens. It can be staked by users to obtain rewards, utilized for paying transaction fees, and also utilized to vote on governance decisions. Moreover, the Burns token will be utilized as a bridge currency to connect BurnSwap with other EVM compatible networks, making it easier for users to exchange token across various chains. So getting into like the tokenomics of this Burn token. So the Burns token has a total supply of 1 trillion with no max supply. I think that's important to note too, right? Like they could still, since it doesn't have a max supply, theoretically they could print, more tokens and increase the total supply. But as of the launch, it will have a total supply of 1 trillion tokens. Each transaction and transfer of the token is taxed at a 0.25%, which is sent to the burn address. And then 40% of the token supply is allocated towards liquidity, and 50% is allocated to the staking rewards pool. So keep in mind, like I said, Burns token is a reward token, which in and of itself can be like these types of reward tokens. Like we've seen these things. I don't know. I mean, if you've been in DeFi for some time now and you were operating within like the DeFi 2.0 space, I would call it, where we were doing a lot of things on DEXs, we were doing LPs and staking tokens and doing all this stuff, right? Typically, no matter what DEX you're staking on, or whatever platform you're staking tokens on, they're paying out in their native token, like they are doing here with BurnSwap. So they're paying out in burns. Now, granted, it has a total supply of 1 trillion, but it can print tokens, right? It's an inflationary token at the end of the day. However, they're implementing these things to help burn a lot of that total supply, which hopefully would keep things balanced, right? Or even deflationary. And of course, when a token is deflationary, that means that the asset should appreciate over time because the asset is less and less out there. Like there's less tokens out there for the public to buy. So as time progresses, in theory, the price of the Burns token should go up. That's not always the way things work. I just want to preface it with that. While this might all sound good on paper, how many times do we see things play out exactly how a project plans for them to be played out? So 50% is allocated to the reward staking pool, and then 10% is allocated to marketing and development. So once the rewards pool is depleted, the token has a function to mint on staking demand. Again, that's going back to the fact that this is not a capped supply. Granted, once these reward pools are depleted, they're going to be able to print more tokens to meet that demand of people that are staking, right? But conversely, it's likely going to be the case that if they need to rely on this function to mint more tokens, that the price is drastically going to be affected of the Burns token, right? So instead of being deflationary, just like we are with the US economy right now, and the government printing money, it just devalues the US dollar. And that same thing holds true here when we look at these tokenomics. So just kind of keep that in mind if you guys choose to interact with this protocol. So let's get into some features. So obviously it's a DEX. They're going to have some swap features. So BurnSwap is a layer 2 solution, EVM compatible networks, starting with Ethereum and Binance Smart Chain. It features a 0.5% burn fee on all swaps with the option to toggle the burn fee off. I imagine if there's an option to toggle, that off, a lot of people would be doing that. But we will see how that goes as they roll things out. Additionally, a 0.167% fee is used to buy and burn the Burns token, while another 0.167% is used to burn the assets being sold and received. So not only are they burning their native token, but they're also burning any assets that are being swapped. So pretty interesting there. And that's one reason why this might be attractive for other projects out there to list their tokens on BurnSwap as a DEX, right? Because those tokens are being burnt, and right off the bat, that gives a project whom might not have any deflationary mechanics built into their tokenomics, it gives them that, right? So that is kind of cool. And really, that's one thing why I even wanted to talk about this project, because that's interesting to me. I don't know of anybody else doing anything like that yet. So BurnSwap also has an auto slippage feature with an on-off button. I would say that the majority, well, no, I don't think PancakeSwap even has that right now. But what that is essentially like, let's just say you're buying a token, it has a 10% buy tax or 15% sale tax. And what this would do is you'd just be able to turn on the auto slippage button. It would be able to account for those taxes, so you wouldn't have to guesstimate on exactly what you would need to set your slippage to in order to account for those buy and sell taxes. Next on the features list, we're looking at charting tools. So BurnSwap offers a variety of charting tools that provide valuable insights into performance of tokens listed on its platform. These tools include a token search function, trading view charts, and data on a token's price, market cap, liquidity, buy-sell transactions, buy-sell volume. of course, over different time frames. Users can also access information on when a token was created and the value of the assets pooled, right? So in the liquidity pair, those are going to be the pooled assets. It gives you, I would imagine, how much money or how much dollars in USD is, let's just say it's this Burns token and it's paired with, BUSD. Let's just say it would give you the value of how much Burn tokens and then also the value of how much USDC is actually pooled in that liquidity pool. Additionally, BurnSwap is developing a swap widget-like feature on a tab for seamless trading. That would be pretty cool. And I don't know if it's like a Chrome browser thing. I don't know how that would work. But to just have like easy functionality to be able to swap tokens without having to go to like PancakeSwap or something like that, I think would be pretty cool. Also, they're also doing swaps. They're also doing bridges. So BurnSwap offers a bridge feature that allows users to seamlessly transfer Burns tokens between EVM compatible networks like Ethereum and Binance Smart Chain. So in this case, what you would do is you would probably swap, let's just say you have USDC on Ethereum that you want to bridge over to Binance Smart Chain. What that would look like would probably be you're converting your dollar value of USDC over to Burns, and then you're bridging the Burns tokens over to Binance Smart Chain, and then swapping your Burns tokens for the equal amount of USDC on Binance Smart Chain. So that's how that bridge feature would work. But it's important to know that a small transaction fee of 0.1% for each transfer is taking place. This feature enables users to move their Burns tokens across different chains and access a wider range of DeFi applications. And again, at the outset, I believe this is only going to be available on Ethereum and Binance Smart Chain with the hopes of adding different chains in the future. The unique slider feature of BurnSwap Bridge allows investors to determine what percentage of tokens they want to sell for gas when bridging to the next chain, right? So if you're bridging tokens to a new chain that you don't have native tokens on yet, you can also allocate some capital for that. So that way, when you bridge funds over, you're also bridging like the gas token on Ethereum. Let's just say you're bridging from Ethereum again over to Binance Smart Chain, but you didn't have any BNB. Obviously, you would want to be able to make sure you had some BNB on that chain as well. So that way you can process transactions on BNB. So it says this solves the common problem of, like I said, not having gas on the chain that you're bridging to. Now, this is where things kind of get interesting in regards to staking. So BurnSwap staking protocol is designed to encourage investors to burn a vast majority of the token supply by offering high yield rewards. So as an investor, we can stake ETH, BNB, or the Burns tokens for a fixed period of time and received Burns token, again, because Burns is a reward token, 80% of any ETH or BNB staked is used to buy Burns and sent to the burn address, and 20% is sent to the protocol's growth fund. 100% of any Burns staked is also sent to the burn address. So lots of burning going there, which sounds pretty cool. The mechanism incentivizes investors to burn their tokens, ultimately reducing the total supply and potentially increasing the token's value over time. Additionally, the staking rewards are paid from the rewards pool, which incentivize investors to hold on to their tokens or continue staking them even after the initial staking period. So let's just check this out. So let's say you have 1,000 Burns tokens and you want to stake them on BurnSwap. You decide to stake them for a duration of 30 days and take advantage of the high APY offered. At the time of staking, the circulating supply of the Burn token is relatively low, so the fixed APY for a 30-day stake period is 1,095%. Again, guys, these are just hypotheticals. This is just kind of like a rundown of how it could look, right? You lock in this rate and your tokens are automatically staked for the next 30 days and receive that 1,095% APY. And again, APY is annual percentage yield, so that's over the course of the year. That's not going to be 1,000% over the 30 days. At least that's my understanding. Over the course of the next month, you earn a fixed high yield reward of 1,095% on your stake tokens. At the end of the 30-day period, your original 1,000 tokens are released along with the additional tokens that you've earned as reward. The fixed annual percentage yield you receive when staking depends on the amount of burn tokens from from the circulating supply that are staked at the time. A significant increase in the stake supply may cause the fixed APY to decrease, while a decrease in the stake supply may cause the fixed APY to increase, right? Because the less amount of people that are staking, the more share ownership that you have of that specific pool, so you would earn more essentially. When deciding the duration and timing of your stake positions, it's crucial to remember this fact. Once you lock in your rate, your APY will remain consistent for the duration of the stake term. So pretty cool there. The BurnSwap staking protocol imposes a 5% fee on the initial stake value and a 5% fee on rewards claimed. So if you decide to buy Burns token and stake them right off rip, you're already down 10%. Because again, there's 5% on entrance, 5% on exit once you go ahead and claim your rewards. Additionally, there is a penalty of 1% per week for stakers who miss the 14-day window to claim their rewards. Right? So if you stake for 30 days and you wait 10 days, then you're going to lose an additional 10% on top of the 10% that you have to pay for, like the 5% on in, 5% on out. So just that's something to keep in mind too. The penalty ultimately results in the tokens being burned, which contributes to the deflationary nature of the token. So they're not taking any money for themselves on that, which is interesting. So if you are not able to come in and claim your rewards, then 1% per day is automatically being burnt, and there's nothing you can do about it until you go ahead and come in and claim your rewards. So here's kind of like a graph or a breakdown on the circulating supply staked and what that fixed APY would look like. So that's kind of interesting as well. They do offer some referrals here. So these referral system allows affiliates to earn 3% in Burns tokens on all stakes made by using their referral link. These tokens are sent directly to the referrer's wallet, and 5% tax on all burns received is sent to the burn wallet. So just another deflationary burn mechanic within the actual protocol itself. And the NFTs, and I know that they had like this NFT launch countdown here, so let's check out exactly what that is. So the benefits of the BurnSwap NFT: burn and hold. When users purchase a BurnSwap launch NFT, they'll have the option to either burn it for 128.5% APY stake booster, or hold on to it and receive revenue from external sources. Burning an NFT provides user with an immediate return on investment, while holding on to the NFT allows the user to earn revenue from external sources over time. This flexibility provides users with the ability to choose the investment strategy that best suits their needs and preferences, and some other bonus benefits there as well. But definitely, I mean, this sounds pretty cool in theory. Who knows if this is actually, how things are going to go when they choose to roll it out. Like I said, they are getting ready to do their seed raise here on, I believe, April 10th. Yeah, so Monday, April 10th. So just in a couple of weeks, about 2 weeks from now, they're looking to raise $15,000 in BUSD. They currently have one of these Gleam giveaways going on. So there's a couple of things that you can do to interact with them on socials and be able to be entered into a giveaway for $500 in BUSD. That being said, guys, it's something that's interesting to me. Who knows? We'll see how they choose to go about things once they get a little bit closer to launching. Obviously, this is something that's kind of very early on. Granted, they haven't even done their seed round investment yet. But let me know what you guys think down below in the comments. Other than that, guys, we will catch you on the next one. Thank you so much for tuning in.